Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at CRWV.
If you find our talks useful, please consider subscribe, liking, comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
Okay, so we are looking at a company that is, it's sitting at the absolute epicenter of the AI boom,
Okay.
CRWV.
Right.
For anyone who isn't familiar, this is basically a specialized cloud provider. They're dedicated just to the most intense AI compute infrastructure.
And the recent performance, it just signals this incredible acceleration in the market. If you want to know what explosive demand looks like, you look at their Q1 2025 revenue.
$346.2 million.
Yeah.
But it's not just the number, right? It's the velocity.
Exactly.
That's the 189% year-over-year increase you're talking about.
Right.
To nearly triple your revenue year-over-year in infrastructure. That's not just growth.
No, it's confirmation. It confirms that the AI industry's hunger for this kind of specialized compute is just, it's vastly outpacing the supply that's out there.
And that hunger translates into quality commitments.
Yes. And this is where the story gets really, really compelling because, we often see cloud infrastructure rely on spot markets or short-term leases.
Right, a lot more volatile.
Very. But CRWV is locking in the heavy hitters, the foundational model developers.
You mean companies like OpenAI, Anthropic, Stability AI?
Yeah.
Those guys, they're the ones driving this contract momentum.
Precisely. And in Q1, get this, 92% of all their new bookings were structured as multi-year minimum commitment contracts.
Wow.
This just fundamentally changes their revenue predictability. They aren't just hoping for traffic.
They have guaranteed revenue streams.
Guaranteed.
Yeah.
Locked in for 3 to 5 years. It's what's backing up all that expansion.
That level of commitment. It says everything about how scarce this specialized infrastructure really is. And you can see that scarcity reflected in their hardware usage.
Absolutely. They have a massive fleet of high-end GPUs deployed right now.
We're talking well over 100,000 units.
And not just any units, the most powerful chips like the H100s, which are, the current gold standard for training large language models. But what's really astonishing is the utilization rate.
It's sitting above 98%.
Think about that for a second. In the general cloud industry, utilization rates, they often hover around 65%, maybe 75% on a good day.
Right.
Finding 98% utilization in a massive, complex system like this is almost unheard of. It basically means every single piece of their hardware is running 24/7.
There is zero fat in the system.
None, which is a direct reflection of that insatiable demand we were talking about.
And that utilization rate has to feed directly into their profitability, right? They're getting maximum efficiency out of every single dollar of CapEx.
It does. And that brings us to the financials. We saw just significant margin expansion in Q1. Their gross margin jumped dramatically to 48.7%.
Up from, 36.1% the year before?
Exactly. For an infrastructure provider, that is an eye-opening leap in profitability.
Okay, so that makes you wonder, how are they doing that? How are they achieving such a rapid margin expansion? Is it just taking advantage of the tight supply to charge crazy prices, or is there something more?
It's strategic efficiency. It's across the board. It's not just opportunistic pricing, it's systemic. There are two main drivers.
Okay.
First, operational efficiency. They achieved a 22% year-over-year increase in power efficiency.
And that's largely from the liquid cooling in their new facilities.
That's it. And that slashes energy costs immediately.
And energy is one of the biggest costs in running a data center. It's second only to the cost of the chips themselves.
Exactly. Which brings us to the second driver. Supply chain leverage. They're leveraging their enormous scale to renegotiate GPU pricing. By striking these direct bulk procurement agreements with the chip supplier, they effectively bypass the traditional channel costs.
So that gives them a significant cost of goods sold advantage that smaller players just can't match.
They're buying smart, not just buying big.
And underneath all of this, all the operational and supply chain wins, they have an actual technology moat, something competitors can't just easily copy. Tell us about that patent-pending tech.
Right. So this is where their engineering expertise really shines. They have this patent-pending technology they call the NVIDIA pooling protocol.
Okay, so in simple terms, what is that?
It's proprietary IP that allows for extremely dynamic GPU resource allocation inside their clusters.
And why is being dynamic so important here?
Because standard virtualization methods, the stuff large cloud providers use, they really struggle to split up high-end GPUs efficiently. So if a client needs, say, 90% of a GPU, that other 10% often just sits idle.
Wasted capacity.
Totally wasted. The industry average for cluster utilization suffers because of this. It often sits around 65%.
But this pooling protocol,
Mm-hmm.
that solves the issue. It lets them allocate those tiny remaining slices.
Precisely. It allows them to boost their overall cluster utilization from that industry average of 65% up to well over 90%.
And that difference, that 25-point jump in usage, is just pure margin for them.
Pure unearned margin. It directly enables that margin expansion that competitors, relying on off-the-shelf cloud software just can't replicate.
That technical edge is massive. Now, what about the balance sheet supporting all this hypergrowth? They closed March with a pretty healthy cash balance of $1.34 billion.
And their ability to generate cash is just as impressive. Their free cash flow, or FCF, hit $168 million in Q1. That is a staggering 48% FCF margin on their revenue.
A 48% FCF margin is outstanding for any company, let alone one in a capital-intensive business like this. So where's all that cash going?
It's being rapidly deployed. The vast majority of that cash, about $1.04 billion of it, is being used immediately to buy more GPU inventory and to fund new facilities.
Where are they building?
Key geographic locations: Iowa, Texas, and crucially, Ireland. They are putting every dollar back into the ground to capture more market share.
Let's talk about the competitive landscape, because this is where the skepticism usually comes in. Why is a dedicated niche player capturing this market when you have giants like AWS and Google Cloud also offering AI infrastructure?
The difference is specialization. It's focus. CoreWeave is a true pure play. They own and operate one of the largest dedicated GPU cluster footprints in private hands.
While the hyperscalers are generalists.
They're generalists. They have to split resources, optimize for thousands of other services. CoreWeave optimizes for just one thing: high-speed, low-latency communication between massive clusters of top-tier GPUs.
Which is exactly what the big AI labs need.
Exactly.
And that specialization creates, I imagine, some serious stickiness for their customers.
Yeah.
Once a big AI lab is set up with them, it's not easy to leave.
It's incredibly difficult, and that is a key part of the moat's durability. Their customers don't just lease hardware. They run their massive, complex models and their colossal data sets on CoreWeave's custom software stack.
A stack that's tightly optimized for that inter-GPU communication.
Yeah.
You're talking about NVLink.
Yes, NVLink. And for listeners who aren't familiar, just think of it as specialized internal high-speed wiring that lets hundreds of powerful GPUs talk to each other at warp speed.
Essentially acting as one giant cohesive brain.
Right. And migrating away from that highly optimized environment is a monumental task.
And monumental translates to dollars and time. What are we talking about for switching costs?
Estimates suggest that migrating a major foundational model and all its data, well, you're talking about costs over $20 million.
Wow.
And 4 to 6 months of development time and downtime just to recalibrate everything on a generic cloud.
That is a switching cost that almost guarantees customer retention.
Which you see in their 98% retention rate. It all connects.
And they have a huge pricing advantage over the bigger competitors, too, because of all that efficiency.
Absolutely. The pooling protocol, the supply chain savings, it means they can significantly undercut the major cloud providers. AWS or GCP often charge 2 times or even more per GPU hour for comparable performance.
And the biggest validation, arguably, comes from the competition itself.
It really is. CoreWeave secured a massive strategic win recently. They were named AWS's exclusive AI infrastructure partner for enterprise inference workloads.
Think about that. AWS, the largest cloud provider in the world, is basically admitting that for this specific critical task, they'd rather partner with CoreWeave than build it themselves.
It suggests a very long-term defensible position.
And it seems the institutional money is buying into this moat. We saw a huge accumulation in Q1.
We did. Total institutional ownership jumped from 43% all the way up to 59% in just that one quarter. When large quantitative firms and big asset managers are piling in, it's a confirmation.
They see this as a powerful, defensible advantage, not just a flash in the pan.
Exactly.
Okay, let's shift to the immediate future. The calendar is packed with catalysts that could really move the needle. The most critical event is the upcoming Q2 earnings report.
That's expected around June 18th, and the guidance is already showing massive confidence. Management guided Q2 revenue to a range of $400 million to $430 million.
And that already beats the analyst consensus. which was sitting lower at, what, $378 million?
Comfortably beats it, yes.
So they've set a high bar, but the market is clearly anticipating even more acceleration for the full year.
Definitely. Management initially guided for $1.4 billion for the full year, but they've already raised that significantly to a range of $1.7 billion to $1.8 billion.
And the thinking is they might raise it again.
Given the accelerating contract momentum, yes, buy-side analysis suggests another guidance raise, maybe pushing the full-year outlook to $1.9 billion or even $2.0 billion could be announced during that Q2 call.
That would be a huge moment.
Yeah.
What about the secondary catalysts happening over the summer?
We have a few key events. First, the European Investor Day on June 25th in Dublin.
Why Dublin?
It's a critical expansion story. They're expected to detail plans for their new $370 million Irish data center.
For the EU-based data sovereignty concerns.
Exactly. They need local capacity to capture those European AI customers. We expect them to unveil some specific EU cloud partnerships during that event.
And then, of course, there's the big one. The relationship with their main chip supplier comes into focus at the summer conference.
Right. The chip company's GTC conference in July is a major visibility event for them. CRWV is scheduled to be there, showcasing real-world performance.
Specifically with models like Llama 3.1 inference.
Right, showing how well it runs on their optimized clusters. And the anticipation is high for a major product reveal, maybe even shared alongside the chip company's CEO. That would just reinforce that critical partnership.
Okay, let's move to the speculative chatter. There's so much growth. There are always rumors flying around. What are the high-interest whispers right now?
There are a few very interesting unconfirmed reports. The first involves negotiating with another major hyperscaler, specifically Microsoft Azure, for a co-branded AI cluster offering.
That would be a massive channel shift. Partnering with AWS is one thing, but if they could co-brand with Azure,
it would open up a whole new world of enterprise customers. It would establish them as the go-to specialized layer for multiple major cloud ecosystems.
And the second rumor is more complex, involving international expansion.
Talk about the Chinese AI company.
Yeah, using their new hubs to navigate restrictions.
Yes. Unconfirmed reports suggest they're negotiating a massive contract, potentially over $1 billion, with a major Chinese AI company. The idea is that by using their EU or Asia hubs, they might be able to offer high-end compute services that sort of mitigate certain export restrictions.
If that's true, it opens up a huge, previously restricted revenue stream.
A non-U.S. revenue stream, yes.
And finally, the next generation of hardware. Everyone is already looking past the H100s.
Right. Market chatter strongly suggests CRWV might be selected for an early pilot deployment of the next-gen Blackwell GPUs.
Has management said anything?
They've confirmed they're in active discussions about next-gen ramp timelines. Securing an early partnership for Blackwell would just solidify their technical lead even further.
As compelling as all this is, we have to address the risks. This whole thing is built on a massive dependency. What's the primary bear case?
The primary risk, and you really can't overstate this, is NVIDIA dependency. Over 95% of their GPU inventory comes from this one single supplier.
That sounds like a massive Achilles heel. Does CRWV have any plan B beyond just hoping the chips keep flowing?
I mean, if that supplier suddenly has a production issue, or worse, geopolitical restrictions broaden,
their entire expansion plan is in jeopardy.
that is the razor's edge they walk. But they are actively mitigating this through forward contracts. They aren't just relying on spot market availability.
So what have they done?
CRWV has secured multi-year supply chains for key chips, including the A800 and H200 variants all the way through 2027. This includes a massive $420 million procurement deal.
So that contract locks in not only supply, but also pricing for the next few years. That gives them huge visibility and stability.
Exactly. It reduces the variability that plagues smaller players. The second key risk is customer concentration.
Right. Given the reliance on those top foundational AI labs, how concentrated is the revenue?
The top 3 clients, OpenAI, Anthropic, and Stability AI, currently account for 54% of their total revenue.
Losing even one of those would be painful.
It would.
But how is that risk mitigated?
It's significantly mitigated by 2 things we already talked about. First, that retention rate is exceptionally high at 98%. These clients are not looking to go anywhere.
And the contracts are long-term.
Exactly. The contractual lengths go well beyond 3 years. The customers are locked in not just by a piece of paper, but by that high technical cost and the massive downtime of trying to migrate.
So wrapping this all up, the core thesis is really about their operational superiority, translating this confirmed market demand into guaranteed, highly profitable revenue.
Absolutely. CoreWeave presents as a high conviction play. You've got confirmed demand, market-leading efficiency. You see it in the gross margin and FCF margin. And this dense cluster of near-term catalysts. The trajectory is strong.
Provided they can maintain that tight, guaranteed supply relationship for the GPUs.
That's the key.
My final thought for you is this. Despite all the momentum and hypergrowth, keep a sharp eye on their execution. The stock is highly sensitive to news from their main chip supplier and their own capacity guidance. The focus shouldn't just be on the quarterly revenue beat, but on how effectively they deploy that significant cash position, that $1.34 billion for continued rapid expansion, without letting that dependency become an unmanageable liability.
That's the true measure of their management skill, the ultimate test.
Check back tomorrow for more smart wealth analysis.